Question 1. Look closely at stock prices falling during a broad economic recession. Which investment risks answer should be selected? Option A, liquidity risk only. Option B, market risk. Option C, inflation risk only. Option D, custodial risk. The correct answer is option B, market risk. A broad recession can trigger market risk because many securities may fall together. Inflation risk is purchasing power loss, liquidity risk is difficulty selling, and custodial risk is not the market movement described. Question 2. Before recording a lesson on investment risks, which term explains a bond backed only by the issuer's general credit? Option A, FDIC guarantee. Option B, debenture credit risk. Option C, secured collateral claim. Option D, SIPC guarantee. The correct answer is option B, debenture credit risk. Debentures depend on the issuer's general credit and carry credit risk. Secured collateral, FDIC insurance, and SIPC protection do not describe unsecured corporate debt. Question 3. If an investment risk stem gives only a fund investing in short-term high-quality instruments, which answer is safest? Option A, closed-end bond fund. Option B, variable annuity. Option C, growth fund. Option D, money market fund. The correct answer is option D, money market fund. A money market fund invests in short-term, high-quality debt instruments and seeks stability. A growth fund targets appreciation, a closed-end bond fund trades on an exchange, and a variable annuity is an insurance contract. Question 4. A quick-fire investment risks video asks about common stock falling because investors become less willing to take risk. Which answer fits? Option A, equity market risk. Option B, FDIC insurance limit. Option C, official statement risk. Option D, bond trustee risk. The correct answer is option A, equity market risk. Equity market risk is the risk that stock prices decline because of market conditions. FDIC limits, bond trustees, and official statements are unrelated to broad stock price movement. Question 5. A quick-fire investment risks video asks about a bond being redeemed when rates have fallen. Which answer fits? Option A, systematic risk. Option B, business risk. Option C, currency risk. Option D, call risk. The correct answer is option D, call risk. Call risk occurs when an issuer redeems a bond early, often after rates fall. Currency risk comes from exchange rates, business risk is issuer operations, and systematic risk is broad market risk. Question 6. After reading the account holding variable annuity investment options, which investment risks concept should not be confused with distractors? Option A, general account. Option B, special memorandum account. Option C, separate account. Option D, sinking fund. The correct answer is option C, separate account. The separate account holds variable annuity investment portfolios. The general account backs fixed guarantees, a sinking fund retires debt, and SMA is a margin account concept. Question 7. Can you spot the investment risks answer when the clue is future coupon payments reinvested at lower rates? Option A, insider trading risk. Option B, default risk. Option C, reinvestment risk. Option D, SIPC risk. The correct answer is option C, reinvestment risk. Reinvestment risk is the risk that income must be reinvested at lower rates. Default risk, SIPC issues, and insider trading are different SIE areas. Question 8. Which investment risks answer is hidden inside the clue nominal return after adjusting for inflation? Option A, sales load. Option B, current yield. Option C, real return. Option D, PR value. The correct answer is option C, real return. Real return adjusts nominal return for inflation. Current yield, PR value, and sales load do not measure inflation-adjusted performance. Question 9. Look closely at fixed payments losing buying power over time. Which investment risks answer should be selected? Option A, inflation risk. Option B, voting risk. Option C, proxy risk. Option D, credit spread risk. The correct answer is option A, inflation risk. Fixed payments can lose purchasing power when inflation rises. Credit spreads, voting, and proxy issues are not inflation risk. Question 10. During investment risks practice, what does the customer gets execution but not a guaranteed price describe? Option A, limit price protection. Option B, stop price activation. Option C, market order price risk. Option D, all or none restriction. The correct answer is option C, market order price risk. Market orders generally provide execution speed but not price certainty. Limit price protection, stop activation, and all or none restrictions describe different order features. Question 11. A candidate sees a company whose earnings rise and fall with the economy during investment risks review. What should they choose? Option A, preferred stock. Option B, defensive stock. Option C, cyclical stock. Option D, municipal bond. The correct answer is option C, cyclical stock. A cyclical stock tends to perform with the business cycle, rising in expansions and weakening in recessions. Defensive stocks are less economically sensitive, municipal bonds are debt issued by governments, and preferred stock is equity with dividend priority. Question 12. During investment risks practice, what does municipal bond repayment depending on project revenue describe? Option A, ETF tracking error. Option B, common stock voting risk. Option C, treasury inflation risk. Option D, revenue bond credit risk. The correct answer is option D, revenue bond credit risk. Revenue bond credit risk depends on whether project revenues are sufficient. Treasury inflation risk, voting risk, and ETF tracking error are different risks. Question 13. When investment risks review mentions the required disclosure explaining standardized options risks, which term applies? Option A, official statement. Option B, options disclosure document. Option C, proxy statement. Option D, account statement. The correct answer is option B, options disclosure document. The options disclosure document explains standardized options and their risks before options trading is approved. Official statements belong to municipal offerings, proxy statements solicit votes, and account statements summarize account activity. Question 14. Pick the SIE term connected to losses from a passive program generally limited against passive income in investment risks. Option A, wash sale rule. Option B, SIPC advance. Option C, dividend exclusion. Option D, passive loss limitation. The correct answer is option D, passive loss limitation. Passive loss limits affect how DPP losses may be used for tax purposes. Wash sale rules apply to securities losses, dividend exclusion is not the DPP rule, and SIPC advances relate to failed brokerage firms. Question 15. Look closely at laws or government actions changing investment outcomes. Which investment risks answer should be selected? Option A, credit risk. Option B, political risk. Option C, extension risk. Option D, opportunity risk. The correct answer is option B, political risk. Political risk comes from government actions, regulations, or instability affecting investments. Credit risk is failure to pay, opportunity risk is missing a better alternative, and extension risk involves slower principal repayment. Question 16. Which investment risks answer is hidden inside the clue: a stock sensitive to business cycle downturns? Option A, market and economic risk. Option B, call protection. Option C, breakpoint risk. Option D, voting dilution. The correct answer is option A, market and economic risk. Cyclical stocks can be hurt by broad economic and market downturns. Call protection, voting dilution, and breakpoint issues are different SIE topics. Question 17. Which answer would pass an exam day check for letters measuring an issuer's credit quality in investment risks? Option A, expense ratio. Option B, ticker symbol. Option C, CUSIP number. Option D, bond rating. The correct answer is option D, bond rating. A bond rating assesses the credit quality and default risk of a bond issuer or issue. A CUSIP identifies securities, a ticker symbol identifies exchange-traded securities, and an expense ratio measures fund costs. Question 18. Under SIE conditions, how should fixed bond interest buying less when prices rise be labeled in investment risks? Option A, CTR risk. Option B, voting risk. Option C, default risk. Option D, purchasing power risk. The correct answer is option D, purchasing power risk. Fixed coupon payments lose purchasing power during inflation. Default risk, voting risk, and CTR reporting are unrelated to purchasing power. Question 19. Does an issuer failing to make interest or principal payments point to which SIE tested answer in investment risks? Option A, legislative risk. Option B, inflation risk. Option C, credit risk. Option D, market risk. The correct answer is option C, credit risk. Credit risk is the risk that an issuer cannot meet payment obligations. Market risk affects broad prices, inflation risk affects purchasing power, and legislative risk involves changes in law or regulation. Question 20. Which investment risks clue points to a broad market decline affecting many securities at once? Option A, liquidity risk. Option B, business risk. Option C, credit risk. Option D, systematic market risk. The correct answer is option D, systematic market risk. Systematic market risk is the risk of broad market movement affecting many securities. Credit risk concerns issuer default, liquidity risk concerns selling difficulty, and business risk is company-specific. Question 21. Which answer would pass an exam day check for bond prices moving opposite to interest rates and investment risks? Option A, no relationship. Option B, dividend relationship. Option C, inverse relationship. Option D, direct relationship. The correct answer is option C, inverse relationship. Bond prices and interest rates generally move inversely. A direct relationship is wrong for ordinary bonds, no relationship ignores rate sensitivity, and dividend relationship applies to equity income rather than bond pricing. Question 22. Before recording a lesson on investment risks, which term explains a fast-moving market causing execution far from the last quoted price? Option A, dividend adjustment. Option B, market order slippage. Option C, bond amortization. Option D, breakpoint discount. The correct answer is option B, market order slippage. Market order slippage can occur when prices move quickly before execution. Dividend adjustments, amortization, and breakpoint discounts are unrelated. Question 23. Does risk that diversification can reduce but not completely remove point to which SIE tested answer in investment risks? Option A, credit downgrade risk. Option B, market risk. Option C, unsystematic risk. Option D, call risk. The correct answer is option B, market risk. Market risk cannot be fully eliminated through diversification because it affects the overall market. Unsystematic risk is company-specific, credit downgrade risk affects issuer credit, and call risk involves early bond redemption. Question 24. After reading a stop order executing far from the stop price after a price gap, which investment risks concept should not be confused with distractors? Option A, guaranteed dividend. Option B, stop order gap risk. Option C, guaranteed limit price. Option D, guaranteed stop price. The correct answer is option B, stop order gap risk. A stop order becomes a market order, so a price gap can cause execution away from the stop price. It does not guarantee the stop price, a limit price, or dividends. Question 25. If an investment risk stem gives only income or called principal being reinvested at lower rates, which answer is safest? Option A, market risk. Option B, credit risk. Option C, call protection. Option D, reinvestment risk. The correct answer is option D, reinvestment risk. Reinvestment risk appears when interest or principal must be reinvested at lower yields. Credit risk is issuer default risk, market risk is broad price movement, and call protection reduces early redemption risk rather than reinvestment risk itself. Question 26. After reading low coupon bonds reacting more sharply to rate changes, which investment risks concept should not be confused with distractors? Option A, greater interest rate sensitivity. Option B, no market risk. Option C, lower duration. Option D, guaranteed PAR trading. The correct answer is option A, greater interest rate sensitivity. Lower coupon bonds usually have greater interest rate sensitivity because more value depends on distant principal repayment. They do not have lower duration by default, no bond is free of market risk, and market prices are not guaranteed to stay at PAR. Question 27. Review the scenario difficulty selling a direct participation program interest, which investment risks choice matches? Option A, DPP liquidity risk. Option B, common stock voting risk. Option C, CTR reporting risk. Option D, treasury default risk. The correct answer is option A, DPP liquidity risk. DPP interests can be difficult to resell, creating liquidity risk. Treasury default risk, voting risk, and CTR reporting are unrelated. Question 28. Review the scenario holding a basket of securities through one exchange-traded product, which investment risks choice matches? Option A, firm commitment. Option B, Form U5. Option C, short sale. Option D, ETF diversification. The correct answer is option D, ETF diversification. Many ETFs provide exposure to a basket of securities, which can help diversification. Short sales involve borrowed shares, firm commitment is underwriting, and Form U5 reports termination. Question 29. Which investment risks answer is hidden inside the clue foreign investment returns changing because exchange rates move? Option A, liquidity risk. Option B, reinvestment risk. Option C, currency risk. Option D, prepayment risk. The correct answer is option C, currency risk. Currency risk affects investments tied to foreign currencies because exchange rates can change returns. Reinvestment risk involves future rates, liquidity risk involves selling difficulty, and prepayment risk involves early principal repayment. Question 30. During investment risks practice, what does an exchange-traded product tied to gold, oil, or another commodity describe? Option A, IRA rollover. Option B, municipal bond backing. Option C, commodity ETF exposure. Option D, stock split. The correct answer is option C, commodity ETF exposure. Commodity ETFs or related exchange-traded products give exposure to commodity price movements. Municipal bond backing, IRA rollovers, and stock splits are separate SIE concepts. Question 31. A SIE investment risks item describes a U.S. traded certificate representing foreign shares. Which answer fits? Option A, ADR. Option B, UIT. Option C, T-bill. Option D, REIT. The correct answer is option A, ADR. An ADR allows U.S. investors to trade a certificate representing shares of a foreign company. A REIT owns real estate assets, a UIT holds a fixed investment portfolio, and a T-bill is short-term U.S. government debt. Question 32. Which investment risks clue points to bond prices dropping when rates rise? Option A, interest rate risk. Option B, political risk. Option C, currency risk. Option D, reinvestment risk. The correct answer is option A, interest rate risk. Interest rate risk is the risk that bond prices decline when market interest rates rise. Reinvestment risk concerns future income being reinvested at lower rates, currency risk involves exchange rates, and political risk comes from government or legal changes. Question 33. Under SIE conditions, how should investment returns failing to keep up with rising prices be labeled in investment risks? Option A, credit risk. Option B, call risk. Option C, inflation risk. Option D, regulatory risk. The correct answer is option C, inflation risk. Inflation risk is the loss of purchasing power when prices rise faster than returns. Credit, call, and regulatory risks involve different problems. Question 34. Which choice best matches a stop limit order activating but not filling because the limit price is missed on an investment risks question? Option A, guaranteed coupon. Option B, guaranteed voting right. Option C, guaranteed market fill. Option D, stop limit non-execution risk. The correct answer is option D, stop limit non-execution risk. Stop limit orders protect price but can miss execution after activation. They do not guarantee a market fill, coupon, or voting right. Question 35. During investment risks practice, what does a large market order moving through several price levels describe? Option A, accrued interest. Option B, tax equivalent yield. Option C, market impact risk. Option D, proxy contest. The correct answer is option C, market impact risk. A large market order may move the price as it executes through available quotes. Accrued interest, tax equivalent yield, and proxy contests are unrelated. Question 36. A candidate sees a customer losing money because securities declined in value during investment risks review. What should they choose? Option A, FDIC stock insurance. Option B, MSRB loss payment. Option C, no SIPC market loss coverage. Option D, full SIPC reimbursement. The correct answer is option C, no SIPC market loss coverage. SIPC does not protect customers from ordinary market losses. FDIC stock insurance and MSRB loss payments do not cover declining securities prices either. Question 37. Which investment risks concept separates limited resale market for a non-traded REIT from the other choices? Option A, tax equivalent yield. Option B, non-traded REIT liquidity risk. Option C, market order price risk. Option D, Form U4 disclosure. The correct answer is option B, non-traded REIT liquidity risk. Non-traded REITs may have limited liquidity because they do not trade like listed shares. Market order price risk, tax equivalent yield, and Form U4 disclosures are different topics. Question 38. What should stand out in an investment risk stem about an ETF trading above or below its underlying net asset value? Option A, breakpoint discount. Option B, surrender charge. Option C, premium or discount to NAV. Option D, bond call premium. The correct answer is option C, premium or discount to NAV. An ETF can trade at a premium or discount to its NAV because it trades on an exchange. Breakpoint discounts reduce fund sales charges, call premiums relate to callable bonds, and surrender charges apply to annuities. Question 39. Under SIE conditions, how should a derivative product needing special risk awareness be labeled in investment risks? Option A. Options guarantee dividends. Option B. Options are insured by SIPC against losses. Option C. Options remove all market risk. Option D. Options are not suitable for every investor. The correct answer is option D. Options are not suitable for every investor. Options can involve leverage, expiration, and assignment risk, so they are not suitable for every investor. They do not remove all market risk, SIPC does not insure against trading losses, and options do not guarantee dividends. Question 40. A SIE investment risks item describes profit potential from a stock price increasing, which answer fits? Option A. Capital appreciation. Option B. Premium amortization. Option C. SIPC recovery. Option D. Coupon income. The correct answer is option A. Capital appreciation. Common stock investors often seek capital appreciation. Coupon income, SIPC recovery, and premium amortization are not stock price growth. Question 41. A SIE investment risks item describes a fund concentrating investments in one industry or sector, which answer fits? Option A. Treasury bill. Option B. Money market fund. Option C. Balanced fund. Option D. Sector fund. The correct answer is option D. Sector fund. A sector fund concentrates in one industry, which can increase concentration risk. Balanced funds mix asset classes, money market funds hold short-term instruments, and treasury bills are government debt. Question 42. Pick the SIE term connected to difficulty selling quickly without reducing the price and investment risks. Option A. Liquidity risk. Option B. Business risk. Option C. Credit risk. Option D. Inflation risk. The correct answer is option A. Liquidity risk. Liquidity risk includes the possibility of selling only at a discounted price. Inflation, credit, and business risks describe different problems. Question 43. Suppose the exam stem says a wide bid-ask spread increasing the cost of selling, which investment risks answer is strongest? Option A. Liquidity risk. Option B. Tax risk. Option C. Reinvestment risk. Option D. Call risk. The correct answer is option A. Liquidity risk. Wide bid-ask spreads can signal poor liquidity and higher trading cost. Call, reinvestment, and tax risk do not describe this trading problem. Question 44. Where does the central bank influencing money supply and interest rates fit inside investment risks review? Option A. SIPC. Option B. Federal Reserve Board. Option C. Transfer agent. Option D. MSRB. The correct answer is option B. Federal Reserve Board. The Federal Reserve Board influences monetary policy, money supply, and interest rates. SIPC protects brokerage customers after firm failure, the MSRB writes municipal rules, and a transfer agent tracks securities ownership. Question 45. Which choice best matches a rating agency lowering an issuer's bond rating on an investment risks question? Option A. Currency risk. Option B. Timing risk. Option C. Call risk. Option D. Downgrade risk. The correct answer is option D. Downgrade risk. Downgrade risk is the risk that a lower credit rating hurts a bond's price. Call risk, currency risk, and timing risk are different concerns. Question 46. Which exam-tested phrase in investment risks is linked to securities moving together when the overall market sells off? Option A. Positive correlation to the market. Option B. Negative amortization. Option C. Currency conversion. Option D. Ex-dividend timing. The correct answer is option A. Positive correlation to the market. Positive correlation to the market means securities tend to move with market direction. The other choices involve debt accounting, dividend timing, or currency exchange. Question 47. When investment risks review mentions company-specific risk that diversification can reduce, which term applies? Option A. Interest rate risk. Option B. Unsystematic risk. Option C. Market risk. Option D. Inflation risk. The correct answer is option B. Unsystematic risk. Unsystematic risk is tied to a company or industry and can be reduced through diversification. Market risk affects broad markets, inflation risk reduces purchasing power, and interest rate risk affects bond prices. Question 48. Which investment risks clue points to extra yield demanded for taking issuer default risk? Option A. Bid-ask spread. Option B. Credit spread. Option C. Option spread. Option D. Underwriting spread. The correct answer is option B, credit spread. A credit spread reflects compensation for issuer credit risk. Bid-ask spreads are trading costs, option spreads are strategies, and underwriting spreads compensate new issue distribution. Question 49. A candidate sees a measure of bond price sensitivity to interest rates during investment risks review. What should they choose? Option A, coupon rate. Option B, duration. Option C, PAR value. Option D, record date. The correct answer is option B, duration. Duration estimates how sensitive a bond's price is to interest rate changes. Coupon rate is stated interest, PAR value is face value, and record date determines who receives a dividend. Question 50. Which investment risks concept separates a common measure of changes in consumer prices from the other choices? Option A, NAV. Option B, CRD. Option C, Consumer Price Index. Option D, QZIP. The correct answer is option C, Consumer Price Index. The Consumer Price Index is commonly used to discuss inflation. QZIP, NAV, and CRD are securities identifiers or systems. Question 51. Review the scenario: existing bond prices rising when market rates fall. Which investment risks choice matches? Option A, CTR threshold. Option B, falling rate price effect. Option C, proxy solicitation. Option D, default filing. The correct answer is option B, falling rate price effect. When market rates fall, existing bonds with higher coupons often become more valuable. Default filings, CTR thresholds, and proxy solicitation are unrelated. Question 52. Identify the tested investment risks concept behind Treasury securities whose principal adjusts with inflation. Option A, revenue bonds. Option B, TIPS. Option C, preferred shares. Option D, strips. The correct answer is option B, TIPS. TIPS are Treasury inflation-protected securities because principal adjusts with inflation measures. Strips are zero-coupon Treasury components, revenue bonds are municipal project-backed debt, and preferred shares are equity. Question 53. Can you spot the investment risks? Answer when the clue is a need to check risk tolerance, liquidity needs, and tax situation before recommending a DPP. Option A, FDIC verification. Option B, automatic approval. Option C, tender offer filing. Option D, DPP suitability review. The correct answer is option D, DPP suitability review. DPPs require careful suitability review because they may be illiquid, complex, and tax-driven. They are not automatically approved for every customer. FDIC verification concerns bank deposits, and tender offer filings are separate. Question 54. For investment risks practice, which option turns receiving premium and taking on an exercise obligation into the correct term? Option A, option writer. Option B, rights holder. Option C, option buyer. Option D, bond holder. The correct answer is option A, option writer. An option writer receives premium and must perform if assigned. An option buyer has a right, a bond holder owns debt, and a rights holder may buy new stock but does not have an options assignment obligation. Question 55. After reading owners paid last after creditors and preferred shareholders, which investment risks concept should not be confused with distractors? Option A, secured claim. Option B, FDIC claim. Option C, residual claim. Option D, senior claim. The correct answer is option C, residual claim. Common shareholders have a residual claim and are paid last in liquidation. Senior, secured, and FDIC claims refer to different priorities or protections. Question 56. Which exam-tested phrase in investment risks is linked to low trading volume, making it harder to sell quickly? Option A, high coupon risk. Option B, voting risk. Option C, low volume liquidity risk. Option D, tax bracket risk. The correct answer is option C, low volume liquidity risk. Low volume can make selling harder without price concessions. Coupon, voting, and tax bracket risks are different. Question 57. A short investment risks question says a bearish or protective options position. Which option wins? Option A, bull spread only. Option B, long call. Option C, long put. Option D, covered call. The correct answer is option C, long put. A long put benefits when the underlying falls and can also protect a stock position. A long call is bullish, a covered call involves selling calls against owned stock, and a bull spread is a different multi-leg strategy. Question 58. A quickfire investment risks video asks about an issuer redeeming a bond when rates fall. Which answer fits? Option A, call risk. Option B, currency risk. Option C, custody risk. Option D, political risk. The correct answer is option A, call risk. Call risk often appears when rates fall and issuers refinance debt. Currency, political, and custody risks do not describe issuer redemption. Question 59. Which choice best matches an ETF seeking a multiple of benchmark returns on an investment risks question? Option A, no-load fund. Option B, treasury bill. Option C, general obligation bond. Option D, leveraged ETF. The correct answer is option D, leveraged ETF. A leveraged ETF seeks a multiple of a benchmark return and can carry heightened risk. No-load funds lack sales charges, general obligation bonds are municipal debt, and treasury bills are short-term government debt. Question 60. Which exam-tested phrase in investment risks is linked to future dollars buying less than today's dollars? Option A, liquidity risk. Option B, business risk. Option C, default risk. Option D, inflation risk. The correct answer is option D, inflation risk. Inflation risk is the loss of purchasing power when prices rise over time. Liquidity risk is trouble selling, business risk is issuer-specific trouble, and default risk is failure to pay debt obligations. Question 61. Which answer would pass an exam day check for an insurance contract whose value changes with separate account investments and investment risks? Option A, money market fund. Option B, fixed annuity. Option C, variable annuity. Option D, treasury bond. The correct answer is option C, variable annuity. A variable annuity's value depends on the performance of separate account investments. A fixed annuity provides insurer guarantees, a money market fund is an investment company product, and a treasury bond is government debt. Question 62. Which choice best matches a portfolio losing value when a major stock index drops sharply on an investment risks question? Option A, SIPC risk. Option B, market risk exposure. Option C, FDIC risk. Option D, tax equivalent yield. The correct answer is option B, market risk exposure. A portfolio that falls with a major index is showing market risk exposure. FDIC and SIPC are protection systems, while tax equivalent yield compares taxable and tax-free yields. Question 63. Pick the SIE term connected to difficulty quickly selling an interest in a partnership program in investment risks. Option A, currency risk. Option B, call risk. Option C, illiquidity risk. Option D, reinvestment risk. The correct answer is option C, illiquidity risk. DPP interests are often illiquid, so selling quickly may be difficult. Call risk involves early bond redemption, reinvestment risk involves replacing income, and currency risk involves exchange rates. Question 64. Identify the tested investment risks concept behind price control that may prevent the order from being filled. Option A, guaranteed fill. Option B, automatic dividend. Option C, firm commitment. Option D, limit order execution risk. The correct answer is option D, limit order execution risk. Limit orders protect price but may not execute if the market does not reach the limit. Guaranteed fills, dividends, and firm commitment underwriting do not describe this order risk. Question 65. Identify the tested investment risks concept behind a measure of how much a stock tends to move compared with the market. Option A, coupon rate. Option B, beta. Option C, current yield. Option D, alpha only. The correct answer is option B, beta. Beta measures market sensitivity relative to a benchmark. Alpha measures excess return, coupon rate is bond interest, and current yield compares income to price. Question 66. Which exam-tested phrase in investment risks is linked to an exchange-traded note exposing investors to issuer credit risk? Option A, voting rights. Option B, ETN credit risk. Option C, FDIC insurance. Option D, breakpoint eligibility. The correct answer is option B, ETN credit risk. An ETN is unsecured debt of an issuer, so issuer credit risk matters. FDIC insurance covers insured bank deposits, voting rights apply to common stock, and breakpoints apply to mutual fund sales charges. Question 67. Which investment risks concept separates many stocks in the same industry falling after negative sector news from the other choices? Option A, Form U5 filing. Option B, sector market risk. Option C, option exercise. Option D, CTR aggregation. The correct answer is option B, sector market risk. Sector market risk occurs when an industry or sector sells off together. CTR aggregation, Form U5 filing, and option exercise are not market risk classifications. Question 68. Which choice best matches cash earning less than the rate of inflation on an investment risks question? Option A, market manipulation. Option B, proxy risk. Option C, inflation risk for cash. Option D, short sale risk. The correct answer is option C, inflation risk for cash. Cash can lose real purchasing power if inflation exceeds the interest earned. Market manipulation, short sale risk, and proxy risk are different concepts. Question 69. When investment risks review mentions a stated return before considering inflation, which term applies? Option A, nominal return. Option B, conversion value. Option C, tax equivalent yield. Option D, real return. The correct answer is option A, nominal return. Nominal return is the stated return before inflation adjustment. Real return adjusts for inflation, tax equivalent yield compares tax effects, and conversion value applies to convertibles. Question 70. Before recording a lesson on investment risks, which term explains risk from holding too much in one issuer, sector, or asset type? Option A, political risk. Option B, concentration risk. Option C, reinvestment risk. Option D, call risk. The correct answer is option B, concentration risk. Concentration risk comes from too much exposure to one area. Call risk involves early bond redemption, reinvestment risk involves lower reinvestment rates, and political risk involves government or country events. Question 71. Where does documenting how much investment loss a customer can accept fit inside investment risks review? Option A, risk tolerance. Option B, CUSIP number. Option C, coupon rate. Option D, syndicate spread. The correct answer is option A, risk tolerance. Risk tolerance is a key customer profile fact for recommendations. Coupon rates, CUSIP numbers, and syndicate spreads are product or offering details. Question 72. Under SIE conditions, how should needing to sell quickly and accepting a lower price be labeled in investment risks? Option A, dividend risk. Option B, OFAC risk. Option C, underwriting risk. Option D, forced sale liquidity risk. The correct answer is option D, forced sale liquidity risk. Forced selling can reveal liquidity risk when a seller must accept a worse price. Dividend, underwriting, and OFAC risks are separate areas. Question 73. How should a candidate classify the minimum equity a long margin account must keep in investment risks? Option A, initial margin. Option B, maintenance margin. Option C, sales charge. Option D, loan consent. The correct answer is option B, maintenance margin. Maintenance margin is the minimum equity that must remain in a margin account after purchase. Initial margin applies at the time of purchase, sales charge is a fund cost, and loan consent allows securities lending but is not the equity minimum. Question 74. Which exam-tested phrase in investment risks is linked to buying a put to protect stock already owned? Option A, protective put. Option B, covered call. Option C, short put. Option D, long call only. The correct answer is option A, protective put. A protective put uses a long put to limit downside on a stock position. A covered call sells upside, a short put creates a purchase obligation, and a long call is bullish without owning the stock. Question 75. Imagine a test item says a position where losses can grow as the stock rises. What is the best investment risks answer? Option A, treasury bill. Option B, short stock position. Option C, long put. Option D, long stock position. The correct answer is option B, short stock position. A short stock position has theoretically unlimited loss potential because a stock price can keep rising. A long put has loss limited to premium, a long stock position can lose only down to zero, and a treasury bill is short-term debt. Question 76. Identify the tested investment risks concept behind thin trading outside regular hours increasing execution uncertainty. Option A, wash sale risk. Option B, FDIC risk. Option C, after-hours market order risk. Option D, bond call risk. The correct answer is option C, after-hours market order risk. Market orders outside regular hours can face wider spreads and less liquidity. FDIC, bond call, and wash sale risks are different. Question 77. Which investment risks answer is hidden inside the clue a preferred dividend that can be missed if not declared? Option A, required coupon payment. Option B, FDIC payment. Option C, dividend not guaranteed. Option D, SIPC payment. The correct answer is option C, dividend not guaranteed. Preferred dividends are not guaranteed because the board must declare them. Bond coupons are contractual, while FDIC and SIPC are protection systems. Question 78. Suppose the exam stem says protection that does not guarantee investment value. Which investment risks answer is strongest? Option A, no performance guarantee. Option B, guaranteed yield. Option C, guaranteed profit. Option D, guaranteed tax result. The correct answer is option A, no performance guarantee. SIPC does not guarantee profits, yields, or investment value. It is a customer asset protection system for failed broker-dealers. Question 79. Which investment risks concept separates price swings in a security caused by overall market conditions from the other choices? Option A, market volatility. Option B, breakpoint schedule. Option C, PAR value. Option D, accrued interest. The correct answer is option A, market volatility. Market volatility refers to price changes caused by market conditions. PAR value, breakpoint schedules, and accrued interest are fixed income or mutual fund concepts. Question 80. A short investment risks question says the difference between ETF performance and the index it tries to follow. Which option wins? Option A, credit spread. Option B, tracking error. Option C, dividend payout. Option D, call risk. The correct answer is option B, tracking error. Tracking error measures how closely an ETF follows its benchmark. Credit spread relates to bond credit risk, call risk involves early redemption, and dividend payout is an issuer distribution concept. Question 81. Which investment risks clue points to an annuity with value tied to separate account investment performance? Option A, variable annuity. Option B, treasury bond. Option C, fixed annuity. Option D, common stock only. The correct answer is option A, variable annuity. A variable annuity's value depends on separate account investments and carries market risk. A fixed annuity has insurer-backed credited interest, a treasury bond is debt, and common stock alone is not an insurance contract. Question 82. Identify the tested investment risks concept behind security pledged to support repayment of a debt issue. Option A, collateral support. Option B, breakpoint support. Option C, dividend support. Option D, voting support. The correct answer is option A, collateral support. Collateral can reduce credit risk by backing repayment. Dividends, voting, and breakpoints do not secure a debt obligation. Question 83. Where does selling borrowed shares and hoping to buy them back lower fit inside investment risks review? Option A, long purchase. Option B, covered call. Option C, rights offering. Option D, short sale. The correct answer is option D, short sale. A short sale involves borrowing shares, selling them, and hoping to repurchase them at a lower price. A long purchase profits from rising prices, a covered call is an option strategy, and a rights offering is a primary market shareholder right. Question 84. A quickfire investment risks video asks about units used to calculate variable annuity payments after annuitization. Which answer fits? Option A, bond points. Option B, annuity units. Option C, accumulation units. Option D, voting shares. The correct answer is option B, annuity units. Annuity units determine variable annuity payouts during the payout phase. Accumulation units apply before annuitization, bond points quote bond prices, and voting shares relate to equity ownership. Question 85. What should stand out in an investment risk stem about the investment account supporting a variable annuity? Option A, separate account. Option B, transfer agent account. Option C, margin account. Option D, general account. The correct answer is option A, separate account. A variable annuity uses a separate account for investment options, so the owner bears investment risk. The general account supports fixed guarantees, a margin account involves borrowing, and a transfer agent account is not the annuity investment account. Question 86. Which investment risks concept separates spreading money across issuers to reduce company-specific exposure from the other choices? Option A, diversification. Option B, front-running. Option C, churning. Option D, concentration. The correct answer is option A, diversification. Diversification reduces unsystematic risk by spreading exposure across different issuers or asset types. Concentration increases exposure, churning is excessive trading, and front-running is trading ahead of customer orders. Question 87. After reading an ETF designed to move opposite a benchmark, which investment risks concept should not be confused with distractors? Option A, inverse ETF. Option B, closed-end bond fund. Option C, money market fund. Option D, cumulative preferred. The correct answer is option A, inverse ETF. An inverse ETF seeks returns opposite a benchmark and may be complex or risky. Money market funds hold short-term debt, closed-end bond funds trade on exchanges but are not inverse by definition, and cumulative preferred concerns missed dividends. Question 88. Which choice best matches a bond rating category generally considered lower default risk on an investment risks question? Option A, control stock. Option B, junk bond. Option C, penny stock. Option D, investment grade. The correct answer is option D, investment grade. Investment grade bonds are generally considered to have lower default risk than speculative grade bonds. Junk bonds are below investment grade, control stock relates to affiliate ownership, and penny stock refers to low-priced speculative equity. Question 89. Which investment risks answer is hidden inside the clue? A long-term fixed income investment exposed to rising living costs? Option A, voting exposure. Option B, AML exposure. Option C, settlement exposure. Option D, inflation exposure. The correct answer is option D, inflation exposure. Long-term fixed payments can be hurt by inflation because purchasing power declines. Voting, settlement, and AML exposures do not describe rising living costs. Question 90. Does a bullish options position with limited loss to premium point to which SIE tested answer in investment risks? Option A, long put. Option B, long call. Option C, short stock. Option D, covered put. The correct answer is option B, long call. A long call benefits when the underlying rises and the buyer's loss is limited to the premium paid. A long put is bearish, short stock gains when prices fall, and covered put is not the basic bullish call position. Question 91. Which investment risks concept separates bond prices moving opposite changes in interest rates from the other choices? Option A, credit risk. Option B, interest rate risk. Option C, liquidity risk. Option D, business risk. The correct answer is option B, interest rate risk. Interest rate risk reflects the inverse relationship between bond prices and interest rates. Credit risk concerns default, liquidity risk concerns selling difficulty, and business risk is issuer specific. Question 92. A short investment risks question says a small company stock with low trading volume, which option wins? Option A, bond call protection. Option B, Rule 144 legend. Option C, SIPC coverage. Option D, small cap liquidity risk. The correct answer is option D, small cap liquidity risk. Low trading volume can make a small cap stock harder to sell at a fair price. SIPC coverage, call protection, and restricted stock legends are unrelated. Question 93. Choose carefully in investment risks. A bond with no periodic coupon showing strong rate sensitivity defines which term? Option A, common stock voting risk. Option B, FDIC risk. Option C, zero coupon bond interest rate risk. Option D, AML risk. The correct answer is option C, zero coupon bond interest rate risk. Zero coupon bonds can be highly sensitive to interest rate changes because payments are concentrated at maturity. Voting, AML, and FDIC issues are separate. Question 94. Imagine a test item says an issuer failing to make interest or principal payments. What is the best investment risks answer? Option A, default risk. Option B, inflation risk. Option C, reinvestment risk. Option D, market risk. The correct answer is option A, default risk. Default risk is the risk that the issuer cannot pay interest or principal. Market risk is price movement, inflation risk is purchasing power loss, and reinvestment risk concerns replacing income. Question 95. Before recording a lesson on investment risks, which term explains an issuer taking a bond back before maturity? Option A, convertible bond. Option B, callable bond. Option C, serial bond. Option D, put bond. The correct answer is option B, callable bond. A callable bond gives the issuer the right to redeem the bond before maturity. A put bond gives that right to the investor. A convertible bond can become stock, and a serial bond matures in installments. Question 96. Which exam-tested phrase in investment risks is linked to being unable to sell quickly near fair value? Option A, call risk. Option B, interest rate risk. Option C, tax risk. Option D, liquidity risk. The correct answer is option D, liquidity risk. Liquidity risk means an investor may not be able to sell quickly at a reasonable price. Interest rate risk relates to rate changes, tax risk involves tax law effects, and call risk is early bond redemption. Question 97. A SIE Investment Risks item describes an over-the-counter security with limited market depth. Which answer fits? Option A, annuity mortality risk. Option B, OTC liquidity risk. Option C, FDIC risk. Option D, Roth conversion risk. The correct answer is option B, OTC liquidity risk. Some OTC securities can have limited market depth, creating liquidity risk. FDIC, Roth conversion, and annuity mortality risks are unrelated. Question 98. Does a customer losing money because a recommendation performed poorly point to which SIE tested answer in investment risks? Option A, no coverage for bad investment advice. Option B, FDIC reimbursement. Option C, full SIPC protection. Option D, MSRB reimbursement. The correct answer is option A, no coverage for bad investment advice. SIPC does not cover losses from bad advice or poor investment performance. FDIC and MSRB reimbursement do not cover that securities loss either. Question 99. Which exam-tested phrase in investment risks is linked to a demand to deposit cash or securities when equity is too low? Option A, dividend notice. Option B, proxy request. Option C, trade confirmation. Option D, margin call. The correct answer is option D, margin call. A margin call requires a customer to add equity when margin requirements are not met. Dividend notices involve distributions, trade confirmations report executions, and proxy requests relate to voting. Question 100. Can you spot the investment risks answer when the clue is high-yield debt with below investment-grade credit quality? Option A, Treasury bill. Option B, money market fund. Option C, junk bond. Option D, investment-grade bond. The correct answer is option C, junk bond. A junk bond is below investment grade and offers higher yield to compensate for greater credit risk. Treasury bills are backed by the U.S. government, investment-grade bonds have stronger ratings, and money market funds hold short-term instruments.